The era of the software subscription might have just died in a single afternoon, thanks to Anthropic. While the headlines are screaming about record highs in the S&P 500, a violent software-mageddon just wiped out nearly $1 trillion in market cap from the tech sector's most reliable names. We are witnessing a historic bifurcation. Capital is fleeing the seat license models of the past and pouring into the hardware and emerging markets that will build the future. If you're still holding legacy SaaS, the ground beneath you just shifted. Welcome to Coffee Break Capital. Financial markets move fast, but we move faster. Sit down, take a sip, and let's get you caught up on the numbers that matter today. Starting with our bearish outlook for the week, the technology sector is currently undergoing a value realization crisis that is separating the builders of AI from the victims of it. The catalyst was the release of Anthropic's Claude Cowork, a suite of advanced AI agents that don't just help humans, they replace the need for them in workflows like legal discovery, compliance, and coding. This has shattered the seat license business model that built Silicon Valley. If an AI agent can do the work of 100 humans, companies don't need 100 software seats anymore. The market reaction was a bloodbath. RELX plunged over 14%, Wolters Kluwer fell 13%, and Thomson Reuters dropped a staggering 18%, as investors realized their moats were being drained. Legacy giants like Salesforce and Adobe are facing what analysts call AI deflation, where the pricing power of tools designed for human users simply evaporates. While the software layer is being commoditized, the CapEx wall is only getting higher. Alphabet and Amazon have signaled a combined 2026 spend of nearly $385 billion just to keep the intelligence grid running. Transitioning now to our bullish stories. The most significant geopolitical shift of the decade just happened in a boardroom. The United States and India have finalized a reciprocal trade agreement that effectively severs New Delhi's legacy ties with Russia in exchange for a golden ticket to the American market. This isn't just a tax cut, it's a strategic quid pro quo. Under the deal negotiated between President Trump and Prime Minister Modi, the U.S. is slashing tariffs on Indian goods from a punitive 50% down to just 18%. In exchange, India is walking away from Russian crude oil and committing to purchase over $500 billion in U.S. energy, tech, and agricultural products. This is being called India's Suez Moment. By locking in tariff certainty, Indian manufacturers finally have the green light for massive capital expansion. For the U.S., it's a deflationary win that secures a vital counterweight to China. While there is execution risk, specifically the inflation that comes with replacing cheap Russian oil with market-rate U.S. crude, the verdict is clear. This is strongly bullish for Indian export equities. Continuing our bullish section, the Warsh regime. Macroeconomic policy in the U.S. is entering a new era. President Trump has officially nominated former Fed Governor Kevin Warsh to succeed Jerome Powell. This marks a departure from data-dependent confusion toward a rules-based monetary philosophy. Warsh is an interesting pivot. Historically a hawk, he is now championing the idea that AI-driven productivity gains can suppress inflation, potentially allowing the Fed to lower interest rates even while the economy grows at full tilt. The Warsh shock has already recalibrated asset prices. Interest rate-sensitive sectors like regional banks (KRE) and small caps (IWM) are bracing for a productivity cut. Even gold surged to a record $5,417 an ounce as a hedge against this radical policy shift. If Warsh can successfully adopt a higher implicit inflation target justified by supply-side expansion, it could provide a massive tailwind for equities throughout 2026. If you want to play the India sovereign alpha thesis, you have two main choices, but they are built very differently. INDA is the national champion play. It is market cap weighted, meaning it buys the biggest companies regardless of their price. Pros: it has massive liquidity and a lower expense ratio of 0.61%. Cons: it's expensive, trading at a PE of nearly 25, and it's heavily concentrated in financials. EPI uses a smart beta approach, weighting companies based on their actual earnings rather than their size. Pros: it's a better fit for the current trade deal. It's overweight in energy, 16.8%, and materials, 14.2%, the exact sectors benefiting from the new U.S. alliance. It also offers a much better margin of safety with a PE of just 18. Cons: it's more expensive to hold, with a 0.84% expense ratio, and higher turnover means it can be less tax efficient. Which one should you buy? For a quick trade, use INDA. But for the long-term structural shift into Indian industrialization, EPI's value tilt has historically delivered superior alpha, outperforming INDA by 118 basis points over the last year. Looking ahead to the rest of 2026, here is our CBC roadmap, the SaaS squeeze. Expect legacy software to remain under pressure until they can prove their AI agents can generate more revenue than they lose in human seat licenses. India's data renaissance. Watch for the February 2026 GDP base year revision. It's expected to mathematically lower India's debt-to-GDP ratio, potentially triggering a sovereign credit upgrade. The pick-and-shovel dominance capital will continue to concentrate in infrastructure winners like Oracle and NVDA, as the AI build-out remains non-cyclical. India stands alone as the premier international growth story, with a projected GDP growth of 7.4% for FY26, nearly double the global average. This information was compiled from various sources across the internet and is not intended as financial advice.